How many people out there right now watching this video feel like they always need to be in a trade? You don't, okay? You really need to sit back and watch the market. Spend more time viewing what's going on in your charts versus always feeling the need to be in a trade. When you start doing that, or if you are doing that, then basically you're suffering from two things. One, being greed, okay? Feeling like I need to make money. I want to make money. I put money into my account. It's time for me to make money, but you really may not be truly prepared to start trading just yet. And then the other is you feel like you're missing out on opportunities. So you miss one good setup or maybe two good setups, and then you feel like you're forced to have to take something that may not pay out or look to be or end up being a great setup. So you just get into the trade, all right? And what happens is if it's not a good high probability zone or setup, whatever strategy you may trade, then you're going to end up losing. So it's better to not trade at all. Okay, if you missed a few opportunities, then force yourself to actually trade. And maybe you're trading because of that greed factor of you feel like you need to make some money today. Look, not every day may be a good solid trading day. Say, for example, like today, we're ranging right now in the markets, and a lot of people are probably struggling trying to figure out, hey, I don't see a clean setup, or they feeling like they see a good setup, but they're ranging. If you remember when I talk about ranges, those are times within the market to where a lot of people end up losing lots of money because they don't know how to trade it. They can trade when the market's trending and when it's breaking just continuing structure to the upside or to the downside because they can see the clear swings. The market's just continuously breaking through structure either up or down. Those are great opportunities, especially to trade supply and demand with. We should all know that by now. So we're going to talk about some tips, 3 in particular, that can really help eliminate the want or impulse of feeling like you always need to be in a position or a trade. I learned this because, trust me, I was just like most of you who are watching this video right now. Okay, when I first started off, especially my first 2 years into the market, I thought trading was going to be easy. It was going to be turnkey. I was going to be able to trade, just within a matter of 30 days and then start making money. Lo and behold, I didn't know that it was going to take me 2 years because I struggle first and foremost with understanding how to read the market the correct way, which is market structure. A big part of the reason why I make these videos is to really push the idea of understanding market structure because it is imperative. It is the key component to actually understanding and learning how to trade the correct way. A lot of people are probably sitting here thinking, well, Mike, what does market structure have to do with, helping me grasp or understand or, kind of eliminate the impulse that I'm feeling to be able to want to always be in a trade? Because it is a solution to helping you understand and see, which way you should be actually trading. All right. So that you hold tight and not forcing trades. If you think that the market is pushing to the upside and you're trading against the grain, then that means that you didn't understand which direction to trade. So you're just trading because of what? Because we're moving lower? Or because we're moving higher, looks like on the charts, but you don't quite understand the overall perspective of what the market is really trying to do. So stay patient, be patient, put your hands in your lap, sit on your hands if you need to, whatever the case may be, but hold tight. First, what you need to do is understand the structure of any particular market that you're looking at. I'm just looking at here on let's just look at the 60 range chart, okay? Now, choose whatever chart works for you from a higher base or higher time frame perspective. Just see, in particular, are we moving lower, meaning breaking structure to the downside, or are we moving higher and breaking structure to the upside? You may even want to scale out even further than that. Maybe some of you may use a day chart, or you may use, if you trade time based, a 4-hour chart, or maybe a 60-minute chart, whatever it is. Like last week I showed a 120 range chart. All I'm saying is just basically scale out, be able to move out, and look at higher base or higher time frame charts to kind of see the overall global direction of the market, all right, and trade in that direction. That's going to help you because if the market is moving on a higher base chart in a certain direction, say to the upside, and you're waiting for a zone or for the market to pull back to a key zone on a higher base chart, then you're just going to wait. You're not going to be clicky into and out of trades all the time. That's going to help you control the impulse. So that's tip number 1. Master market structure. Important stuff there, okay? Number 2, it's just a matter of being patient. That's really all it is, okay? The thing about trading is that you don't have to take 10 trades a day. Look for 1, 2, maybe 3 high probability good trades. Sometimes it just takes 1 trade and you're done for the day. This is going to help you eliminate the impulse as well, because instead of thinking or feeling like you need to take 10 trades in a day, just focus on a few good setups. Ones that are really you feel comfortable about, that give you multiple means of confluence and confirmation. Again, patience. All right. How do we do that? We just sit back. We look for zones where we have lots of confirmation, where we have lots of confluence. Does it make sense to take a trade from an area to where you have 1 means of confluence? Okay. 2 means of confluence, 3 means of confluence. The more confirmation, the more confluence you have at a particular zone, that's going to increase, okay, the opportunity. That's going to increase the probability of that trade working out in your favor, okay? So number 1, market structure. 2, patience. Patience, how does that help us? Okay, we just simply be able to put a filter in place. That's what patience is all about. Waiting it out. Okay, putting a filter in place. What's your filters? Well, I'm going to look for zones that have 3 means of confluence to give me more confirmation to want to get into a trade. Not 1, not 2, but 3. So again, the more confirmation, the more confluence you have at a particular zones, then again, the higher the probability it's going to work out more so in your favor. Okay, and then you start to eliminate risk as well. You'll feel more comfortable about the trades you take. You take 3 trades, maybe 2 work out and 1 don't, you're still green for the day. Depending on, how you really manage, practicing proper trade management. That's another topic, because all that surrounds is basically understanding, how to manage a trade in reference to where to place your stop at and things of that nature, when to get out at if the market comes back against you early enough to protect your capital. And that should be your goal. The number 1 thing is making sure that you protect that nest egg, okay, your money, your capital, because without that, we can't do what we want to do, what we need to do to be in these markets, and that's to make money, okay? And it gets easier as time goes along, and I know that people starting off think that, trading is a scam, it doesn't work out, somebody's always on the opposite end, taking from me or setting me up. Well, okay, we've all been there, we've all felt that way, but you'll find in time, if you are taking the right trades from the right locations, that they'll tend to work out more so in your favor, and you won't feel like the market's always out to get you. Okay, so be patient. All right, put some filters, some parameters in place to help you determine which zones make more sense, confluence, confirmation. All right, I'm gonna take 3. I'm gonna put 3 of those in place. I want to see this, and this happen before I take my trade. Okay, so just think about it from that standpoint. And it's basically number 3 is just practicing on having the right strategy, putting together, devising the right strategy. Lots of times when I trade, I love to see liquidity being taken out. You have to understand this one thing, and this is tip number 3, because this helps me out, and I'm sure it helps a lot of people who are more experienced in trading as well. Someone always has to lose for a trade to really work out and fly in one particular direction. So if you're looking to go short at a particular zone, liquidity. Remember when I talk about that? Oh, Mike, what does that mean? Liquidity is just areas where money is resting in the market. A lot of times the banks, institutions, they'll set up traps. They'll set up liquidity pools in a sense, all right, for retail traders to want to get into a trade at a specific area, and they'll set up multiple locations or small zones, if you want to call them that, or internal areas or zones, to where they'll entice you to want to, say, sell. Okay, the market's moving lower, and they'll set up multiple areas like that. Okay, think of it like a mouse trap. you have a swing to the downside. Let's take an example right here. Let's see here. Let's look at it here on the chart. You see where the market started running lower right here? What do? We pull back pretty good right here, pretty significantly, right? Nice pullback, retracement. And then we broke lower. But within this swing right here, this is a range, and within it we have internal swings, or smaller areas of where there's internal breakup structures to the downside. Now, at the back end of each one of these highs are liquidity. All right. So if you have multiple swings within a range that are developed or created before the market breaks structure to the downside, say below here at 251 or 252, okay, you have to think, could they test the first area or swing? All right, the first internal structure, the second one, the third one. If there are multiple ones, think of it like this. I want to see, some liquidity being taken before I actually get into my trade. So again, maybe we're talking about number 2 as well, to where we're putting parameters in place, okay? Having more confluence or confirmation, and that could be part of liquidity. I want to see liquidity being taken out. Because the banks and institutions are always seeking areas of liquidity, but they set up traps in creating those areas of liquidity to entice retail traders to want to trade at specific areas. And then when they say, for example, right here, let's say you went and sold at this area right here to the downside. All right. Well, they ran up there. They pulled and they rejected that area. But look what they did. The bigger move was when they got back up to the top up here where the original selling really took place at, and they rent everything to the bottom and they took out the low right here. You see that? But they grabbed liquidity. They set up this opportunity. They push me a low, lower high. Boom. I mean, well, it's not. Yeah, it's a lower high in comparison to this high here. But the market broke to the downside and broke structure here. There's liquidity resting right here at the back ends of highs and lows, or equal highs and lows as well. So when the market started retracing back to the upside, okay, let's say you got in right here and you tried to hold the trade through thinking the market was going to continue pushing lower. Well, there's also an opportunity. There's an area of supply resting right here. So you have to think, logically speaking, that all areas of gaps or imbalances, voids need to be and have to be filled. So they're going to run the market back to the upside. You were into a trade going short right here. You became liquidity, and that's what they want. They want people to start selling right here to force you to sell so they can grab more money to fuel them to continue with their positions or moves to the downside like they did right here. So you have to think in terms of like that as well. The market sets itself up in a big range, like a big swing right here. Where we've got, where it starts to range in a sense, and we're still ranging quite bit, some in this area right here. Because if you look at the market, what could it do? Well, it hasn't broken this high here, and it hasn't broken this low here yet. So are we going to break structure to the downside, or are we going to continue running to the upside, taking out minor areas of structure back to the upside? Okay, so you have to think and be able to see the market from a full scale to understand what it's really trying to do, but always be thinking in terms of liquidity. Somebody always has to lose before someone wins. And most times, again, that's always more likely is going to be the banks and institutions, because they're the ones that are driving the markets. So you want to ride their coattail. You want to understand and play the same game of cards that they're playing. Oh, liquidity. Let me use that as part of my arsenal to help me get into beta trade setups. The banks, okay, I see where they are setting up this range at, okay, this trading range at, and they're setting up multiple zones or locations. There's 3 there. They're probably going to run through maybe the first one and then maybe go up to the second one and reject that area. Or could they take out both of them? That's just a matter of waiting to see. We don't know. But you always must think in terms of liquidity, because they will take out areas or levels or swings, okay? All right? Just to fuel their positions even more. Because if you think about it in terms like this, if the market is running lower here, and it can reject here, but it can reject here, at what area are the banks or institutions getting into a better price element or zone to be able to sell from? Think in terms of premiums and discounts. The premium is up here. They want to sell at higher prices. We want to buy at lower prices. So think in terms of them. So when they grab liquidity and position themselves to be able to sell at a higher price, guess what? This is the better area to sell from. They just grab liquidity. Okay. You became liquidity if you shorted here. All right. Especially if you tried to hold it. It ran back to the upside, stopped you out here. And then they stopped these traders out here that were short from this area here. Now, it goes up here. They're at a better price area, okay, above a high volume area, lower volume. They're going to run it back down towards the mean. Remember, I talked about the volume profile and back below the break structure. So understand those type things. This will help you eliminate the impulse, the need to always be into a trade, because then you start to focus on more so, I'm becoming a better trader because I understand how the markets are moving. What fuels them? Liquidity is what fuels the market. Again, somebody always has to lose before a better opportunity of move takes place. So use liquidity as a tool, but also understand and practice patience and putting some filters in place. And number one, understand how to read the market by simply understanding, mastering, grasping market structure. I'm going to leave it there for you guys. Hopefully this resonates and hopefully this helps lots of traders out there hopefully it does. But anyways, if you found value in today's content, in today's topic, in today's video, please become a subscriber today. All you have to do is simply click on the sub button down below. Make sure to turn on all your post notifications. If you are wanting to become a Discord member, all right, come over and join us. It's free. Find the link down in the description portion of the video. If you're wanting to grasp a better understanding of the actual trades that I take, now I do post my trades that I take, most of them anyway, when I'm trading during the U.S. session or the New York session, which is 9:30 to basically 4 Eastern time, because but I primarily trade during the first 2 hours of the market opening. Then you might want to become an elite channel member. Okay, it's only $6.99 a month, and what that gives you is the trade breakdowns. That's where I go into detail. I go into detail about the trades that I actually take, as if you're sitting right next to me. I break things down as the most in the most simplest form as possible, so you understand my thought process leading up to a trade, why I took that trade, my TP areas, stop losses, as well as you get the video playlist. So we're talking about $6.99. And this has helped lots of traders who are part of the Discord community as well. Because when you can start understanding and seeing and someone explain to you why they took a trade, then it starts to, things start to unfold as far as you being able to see things more clear. So it might be something that you may want to think about really, kind of signing up for if you choose to. But make sure you're supporting my efforts as a content creator here on the YouTube platform. They come up with these tier-based programs or subscription-based programs for content creators, and this is one of the perks or rewards that I give back are the trade breakdowns, as well as you get the video playlist, and then the other little perks like the emojis, the badges, and the priority reply to comments. But for $6.99, I mean, you really can't beat that deal or whatever the case is, because you're getting so much value back, okay? Especially, if you really want to understand in the breakdown of the trades when it comes to, because I trade supply and demand, so that you can understand the strategy and how I trade. And that's what I do. I go into detail about the strategy and how I trade it, and you can see it through the trades that I actually trade. Through the trades I take. But outside of that, that's really all I have to discuss today. Hopefully, again, this helps someone out there who has or suffers with the issue of always feeling like they need to be in a trade. They cannot control their impulse. You have to that's a psychological thing, and you really have to do away with that behavior if you really want to make it in this business today and going forward and succeed, okay, and become profitable. Again, people think that trading is not a means or a way to be able to make money or whatever the case is. And look, there are plenty of people out here, and it's not for everybody, but I'm just saying it is definitely a way to become financially free if you can know how to do it the correct way. But that's all I have. I appreciate each and every one of you tuning in. If you found value in today's video, please drop a like on it, and I will see you in the next one. Take care.